What if you could invest in three iconic Singapore companies that power tourism, leisure, and transport, yet hold more cash than debt and still fly under the radar? No hype, no speculative tech. Just steady, cash-rich businesses that serve millions every year, rain or shine. These may be your most resilient anchors when the next crash hits. Hey investors, welcome back to Durian Finance, where we decode the best income and value stocks across Singapore and Asia. In today's video, we reveal the top 3 recession-resistant stocks in tourism, leisure, and transport. Genting Singapore, the casino and hospitality titan, ComfortDelGro, Singapore's largest land transport operator, and SUTL Enterprise, a niche leisure group with global marina exposure. We'll break down their financials, resilience, and end with a head-to-head comparison, so you'll know which one fits your portfolio best. Let's dive in. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial advice. Please do your own research or consult a licensed advisor before investing. Best known for Resorts World Sentosa, Genting Singapore stands tall as the beating heart of Singapore's tourism sector. It operates integrated resorts, luxury hotels, a casino, Universal Studios, and the SEA Aquarium, pulling in millions of visitors annually. Let's break down Genting's FY 2024 performance. Metric overview. Revenue hit 2.2 billion Singapore dollars, a strong rebound post-COVID and reopening-driven tourism flows. Net profit surged 54% to 606 million Singapore dollars, reflecting both top-line growth and cost efficiencies. EBITDA margin is an impressive 46%, showing that Genting runs a very lean and profitable operation for a capital-heavy industry. And here's where it really stands out: the balance sheet. Genting holds a massive 3.3 billion Singapore dollars in cash and zero borrowings. That means its debt-to-equity ratio is 0%, a rare feat in the hospitality sector, where most peers are heavily leveraged. From a valuation perspective, P/E ratio is 13x, which is reasonable given its profitability and recovery upside. EV/EBITDA is just 5.9x, attractive compared to global casino or resort operators. Price to book is around 1.0x, meaning it's trading close to its intrinsic asset value. Not overvalued, not hyped. On top of that, Genting is rewarding investors with a 4.5-cent dividend, translating to a 4.5% yield, fully covered by earnings and free cash flow. The company is also planning big, committing 4.5 billion Singapore dollars to expand and refresh its attractions, including upgrades to Universal Studios and the SEA Aquarium under the RWS 2.0 plan. In a nutshell, Genting Singapore is a rare tourism stock with zero debt, strong cash flow, steady dividends, and long-term growth potential as travel rebounds. ComfortDelGro isn't just a household name. It's the largest land transport group in Singapore, running taxis, buses, MRT lines, and even driving schools across 7 countries, including the UK, Australia, and China. And in FY 2024, the company staged a solid rebound. Revenue climbed to 3.7 billion Singapore dollars, up 7.8%, fueled by rising ridership and better economic activity. Net profit reached 180 million Singapore dollars, recovering from COVID-era lows. And with 760 million Singapore dollars in EBITDA and a 14% EBIT margin, Comfort proves it can manage costs well, even with rising fuel and wage pressures. What makes Comfort stand out is its strong financial position. Despite being asset-heavy, it still holds 840 million Singapore dollars in cash, compared to about 500 million Singapore dollars in debt, giving it a net cash buffer of 340 million Singapore dollars. Its debt-to-equity ratio of 29% is healthy, showing prudent leverage. From a valuation angle, ComfortDelGro trades at around 12.8 times earnings and a very reasonable EV/EBITDA of 5.2x, attractive for a blue-chip defensive stock. And let's not forget dividends. The group paid out 6.1 cents per share, translating to a 5.5% yield, fully backed by cash flows. That puts it among the top dividend payers on the SGX. Beyond the numbers, what makes ComfortDelGro resilient is simple: Transport is essential. In good times or bad, people still commute to work, school, or appointments. Add to that Comfort's digital upgrades, its growing electric vehicle fleet, and overseas growth. And you have a stable business model with long-term visibility, reliable, upgrading, and diversified. ComfortDelGro is built to ride out any economic storm. While Genting and Comfort dominate the headlines, SUTL Enterprise quietly thrives in a very different but highly profitable niche: luxury marinas and waterfront leisure. Best known for 1°15 Marinas in Tosa Cove, SUTL operates private yacht clubs and marina developments across Singapore, Indonesia, Malaysia, China, and more. In FY 2024, the company posted 44 million Singapore dollars in revenue, stable and recurring from marina fees, berthing, and membership. 6.2 million Singapore dollars in net profit, showcasing steady earnings from high-margin operations. A strong EBITDA margin of 25%, highlighting solid cost control and pricing power. But the real gem here is its balance sheet. SUTL is entirely debt-free, holding 36 million Singapore dollars in cash and carrying no bank loans. That translates to a debt-to-equity ratio near 0%, giving the company enormous financial flexibility. From a valuation perspective, the stock trades at just 6.5x earnings, extremely low for a company with consistent profits. Its EV/EBITDA of 3.1x is among the lowest on the SGX, especially for a cash-rich leisure brand. And with a price to book of just 0.55x, SUTL is literally trading at a 45% discount to its net asset value. Dividend-wise, SUTL delivers too. It pays 2 cents per share, giving investors a 5.2% yield, fully supported by operations and cash flow. So, why does this company matter? Because it caters to a growing affluent class across ASEAN and China. Yachting, private waterfront clubs, and marina real estate. These are lifestyle trends that don't go away in downturns. In fact, they often thrive quietly as the wealthy seek privacy, exclusivity, and leisure experiences. SUTL Enterprise may be small cap, but it's a net cash, high-margin, dividend-paying gem that offers deep value and niche growth in a sector most investors overlook. Now let's stack these three resilient SGX stocks side by side and see how they compare. Starting with revenue, ComfortDelGro leads a pack at 3.7 billion Singapore dollars, thanks to its massive global transport network. Genting Singapore follows at 2.2 billion Singapore dollars, driven by Resorts World Sentosa and tourism. SUTL Enterprise is smaller at 44 million Singapore dollars, but it plays in a niche luxury segment. Net profit tells a different story. Genting dominates with 606 million Singapore dollars in profits, a clear indicator of its high-margin business. ComfortDelGro earns 180 million Singapore dollars, stable and reliable. SUTL earns a modest 6.2 million Singapore dollars, but consistent for its size. Next, dividend yield. ComfortDelGro offers the highest at 5.5%, a favorite for income-focused investors. SUTL isn't far behind at 5.2%, very solid for a small cap. Genting delivers a reliable 4.5%, fully backed by strong free cash flow. In terms of net cash position, Genting is in a league of its own with 3.3 billion Singapore dollars in net cash. ComfortDelGro has 340 million Singapore dollars, maintaining a strong buffer despite being asset-heavy. SUTL remains debt-free with 36 million Singapore dollars, impressive given its lean size. Now, let's talk valuation. On AP basis, SUTL is a value pick at just 6.5x earnings. ComfortDelGro sits around 12.8x, and Genting at 13x, both reasonable for blue chips. On PB ratio, SUTL trades at just 0.55x, meaning you're buying assets for 55 cents on the dollar. Genting trades at 1.0x, and Comfort a slight premium around 1.2x due to its stability. What about business resilience? ComfortDelGro scores the highest with very high resilience, thanks to essential daily transport needs. Genting and SUTL are also highly resilient, backed by strong brands, loyal customers, and recurring cash flow. Lastly, the growth outlook. Genting is doubling down on tourism with RWS 2.0, a multi-billion-dollar expansion. ComfortDelGro is investing in electric vehicle fleets, digital platforms, and international growth. SUTL is expanding its 1°15 marina brand across ASEAN and China, targeting high-net-worth leisure demand. Final takeaway. Choose Genting Singapore for strong cash, global tourism upside, and mega expansion plans. Pick ComfortDelGro for income, essential services, and international stability. Go with SUTL Enterprise if you're hunting for deep value, zero debt, and exposure to niche high-end leisure. No hype, no drama. Just 3 cash-rich, dividend-paying SG businesses. Ready to ride out any crash. From casino chips to MRT rides to marina yachts, these are real businesses that thrive even when markets tumble. So, which one are you betting on? Comment below, Team Genting, Comfort, or SUTL. Like this video if you found it helpful. Subscribe to Durian Finance for more no-nonsense SGX stock insights every week.